I'm Matt Morzy from Annex Wealth Management with What's That? What's diversification? When it comes to investing, diversification is a strategy that involves spreading your investments across a variety of assets or asset classes like stocks, bonds, real estate, commodities, etc., to reduce risk. The idea is that by not putting all of your money into one type of investment, you can smooth out your investment experience. Diversification has many different levels of application. Let's look at stocks versus bonds as an example of that first level of diversification. You may have heard about the 60-40 portfolio, a popular allocation designed to represent a moderate investor, where 60% of the portfolio is in stocks and 40% is in bonds. It's not too aggressive, yet not too conservative. 60-40 is based on the principle that different assets tend to perform differently under various market conditions. For example, when stocks are down, bonds might be up, or vice versa. The second level of diversification is examining how you're investing within the stock portion of your portfolio and how you're investing within the bond portion. The 60% that makes up the stock portion might require further diversification between U.S. companies, international companies, and even with international companies, there are both developed countries and emerging market countries. Within stocks, you'll have large companies and small companies, or growth in value. On the fixed income end, you might have lower risk bonds, such as U.S. Treasuries, or more aggressive bonds, such as high yield or credit focused bonds. By blending together different types of stocks, it can make the overall stock portion of your portfolio less risky, and the same within fixed income. It's important to note that while diversification can help manage risk, it does not guarantee against loss or ensure a profit. The strategy aims to improve risk-adjusted returns over time by limiting exposure to any single investment or risk factor. And one last thing, there's an old saying that diversification means always having to say that you're sorry. What that means is that when you diversify, there'll be parts of the portfolio doing really well, and others that just are not keeping up. For many investors, that can be really frustrating that not everything is beating their overall benchmark. But when diversification is the goal, you're more likely to be ready for an event like a market sell-off. At that time, it's likely the thing that was just trailing is now holding up better and helping reduce how much your portfolio is down. That's diversification. If you're wondering exactly how to diversify your portfolio, finding an advisor you could trust to help. For more What's That? Topics like this, visit our YouTube channel. Thanks.